Okay, it looks like most people have responded, and thanks so much for doing that. It's always great for us to know who's in the room, especially on a webinar such as this, where we can't directly see or hear from the audience. It looks like we have a really healthy mix of backgrounds, with a lot of banking professionals and regulators on the call, as well as a meaningful number of nonprofit and policy-focused folks. Well, once again, to all of you, welcome, and thanks so much for joining Ideas 42's webinar on the provider and consumer experience with small dollar loans. Over the next hour or so, we'll explore the consumer experience through a short presentation from myself on Ideas 42's research with bank offered small dollar loan customers. We'll then move towards unpacking the provider or bank experience in delivering these loans. I'm really looking forward to hearing from an all-star cast of panelists that are on the call today. And Ideas 42's Lois Ayi will guide that discussion across a range of burning issues in this space. We'll round out the webinar with questions from yourselves, the attendees, and you'll notice a Q&A feature available on Zoom today. Please feel free to drop your questions for either the panelists or the Ideas 42 team into that Q&A at any point during the webinar, and we'll get to as many of these questions as possible during the final section. Just one other note on the Q&A. If you have a question that you want to direct directly towards one of the panelists or Ideas 42 team member, just be sure to note the name on the question if you wish to do so. Now, before I jump into the insights from our consumer research, I wanted to spend a minute contextualizing Ideas 42's interest in small dollar loans. We know that millions of consumers across the country do not have access to affordable small dollar liquidity during their moments of financial disruption. Whether they're dealing with an inflated utility bill, copay from an unexpected medical procedure, or an income shock, consumers are often compelled to turn towards high-cost alternatives or foregoing those expenses or obligations altogether and dealing with the fallout. We know that low to moderate income consumers and families of color are more likely to confront these situations, and they are also more likely to have to turn to those alternatives that can undermine their financial health and well-being. Bank offered small dollar loans, in contrast, have the potential to offer affordable credit to those families during their times of need and financial distress. To that end, 6 of the 8 largest banks in the country, as well as dozens and dozens of smaller banks and credit unions, have launched and are expanding their small dollar products. Last year, Ideas 42, with the generous support and partnership of the Pew Charitable Trusts, mapped this market for small dollar loans. We engaged with a variety of experts, stakeholders, and providers to understand some of the live questions and research gaps in this space. We also spoke to banks with and without small dollar products to understand some of the drivers and barriers they were facing when considering launching a small dollar product in particular. One of the biggest questions that stakeholders and banks posed to us was around the consumer experience. Specifically, what sorts of effects wider access to bank offered small dollar loans is having on consumers' broader financial situations and financial health. I'll spend the rest of this presentation discussing our consumer research with borrowers in an attempt to shed some light on that question. So between September and October of 2023, we were able to conduct qualitative research with small dollar loan borrowers thanks to our partnership with Saver Life, a nonprofit and advocacy organization that uses technology to improve the financial health of people living on low to moderate incomes. We sent a screener to Saver Life members with active accounts at the 6 major banks offering small dollar loans, asking those members if they had taken out a small dollar loan at their bank. And then for those who had, we asked them follow-on questions on their experience. Of those 54 borrowers who took out a screener on their experience, 10 of them also participated in an hour-long interview with our team. In general, borrowers from both the screener and the qualitative interviews varied meaningfully across a range of characteristics, including age, race, education, and income. Although I should note the borrowers from our qualitative interviews tended to be slightly better educated and wealthier than our screener respondents. Now, the insights that will come over the next few slides will come from both the screener as well as the qualitative interviews. And if you pay attention to the top left-hand side of each slide, you'll find where we drew that information from. So from the screener, we learned that a majority of borrowers were seeking a small dollar loan because they had experienced an unexpected expense of some kind. So roughly 1 out of every 2 borrowers had experienced an unexpected expense. Roughly a quarter of respondents feel that they regularly have insufficient income, while a smaller percentage, roughly 1 out of every 7 borrowers, experienced either an income shock or were unhappy with their existing alternatives. In our qualitative interviews, as in the quotes in the bottom of this slide, borrowers had the chance to be a little bit more specific on their reasons for applying, mentioning situations like unexpected bills, car and house repairs, or paying for school books. On our screener, we also asked borrowers if they had used an alternative product such as overdraft or a non-bank loan in the past year. Borrowers that had used an alternative were then asked if they had stopped using that alternative since having access to their small dollar loan. Looking at our results, we paid particular attention to non-bank loans as an area of interest to stakeholders and other parties. While 1 out of 3 screener participants had used a non-bank loan, 3 out of every 5 of them have since stopped using this product as they started to use their small dollar loan. Now, I should note that while this result comes from a screener of borrowers that do not necessarily represent the broader population of small dollar loan borrowers, it does tentatively indicate to us that indeed some borrowers are substituting their high cost products for bank offered small dollar loans. Interestingly, borrowers are not replacing their buy now, pay later products at similar levels. And one borrower in our qualitative interviews helped to explain this screener data quite eloquently when they describe using their BNPL service to facilitate the wants that they had in their life, while their small dollar loan tackled the needs that they confronted. In our qualitative interviews in general, borrowers mentioned that many of their alternatives were a pain to access, stressful to deal with, or were particularly expensive. This was in contrast to the experience that most borrowers had with their small dollar loans, which was overwhelmingly positive. This began at the outset, where they found applications to be straightforward, convenient, and quick. When comparing their application to borrowing from friends and family or an in-person payday lender, borrowers preferred being able to access credit privately and on their phones. Borrowers mentioned receiving funds quickly and in time to meet the pressing obligations that brought them to the application in the first place, and they were rarely surprised by hidden terms or features on a loan. Borrowers, largely without exception, also mentioned to us the affordability of their bank offered loan, with the prices they were paying comparing favorably to many of their alternatives. And related to that on the repayment side, borrowers appreciated the smaller monthly payments and the longer runway to pay off their small dollar loans, finding the repayment process to be less stressful than with a lot of their other alternatives, including advanced products or those products with balloon payments. We also asked borrowers to consider if access to their small dollar loan had changed their perception of their banks in one way or the other. And in general, borrowers reported having a more favorable view. This was true for borrowers who were previously upset or happy with their bank. Unsurprisingly, then, all borrowers noted to us that they would recommend the product to those in their social circles, and they would use them again themselves. In fact, the majority of our interviewees had used their small dollar loan more than once to deal with a financial challenge. Finally, some borrowers mentioned that they felt that the banks that were offering small dollar loans as a part of the deposit relationship were doing more for them than the banks that don't currently have a small dollar product. Now, while borrowers had a largely positive experience with small dollar loans, there were a few concerns over our conversations that cropped up as areas for improvement. On the application side, while borrowers were aware about the use of relationship history and cash flow and eligibility, they do have a stubborn mental model that banks always use credit reports and felt that this was the case with small dollar loans as well, even though only a minority of banks pull a report. Many borrowers mentioned to us that they would prefer the banks to only use relationship history for approvals and eligibility, if at all possible. On the flip side, borrowers expressed a desire to build credit alongside their small dollar loan, and they support reporting repayment history to credit bureaus, even though they themselves are personally unaware if their small dollar loans are impacting their credit. Some of our borrowers were not approved for the upper limit of their loans, leaving them confused and wanting greater clarity on some of the reasons why. Again, I think this emphasizes that while borrowers understand that relationship history is a factor in approvals, this is still a relatively new concept and product to them. And so they're not always aware of what they can do to improve their appeal. And finally, borrowers mentioned wanting slight increases in the upper limit of some of the loan sizes and wanting to graduate or pathways to graduate to traditional credit products as well. Now, before I hand it over to Lois, I wanted to offer a brief picture of the main themes Ideas 42 heard from providers around their experience delivering small dollar loans. And I hope this will set up the panel discussion that's to follow. So 5 main headlines came out of our conversations with banks around their early experiences. In general, they're experiencing healthy uptake, with Bank of America, for instance, recently announcing that they have already dispersed over $500 million or 1.1 million small dollar loans since their product launch. Banks are also exceeding expectations around repayments, and as a result, loss ratios are lower than expected. One bank provider actually mentioned to us that they were quite surprised by how highly customers were prioritizing repayment on small dollar loans relative to sort of conventional expectations or theories around repayment hierarchies. We also saw this in our research, where borrowers mentioned wanting to pay early so that they would maintain access to their small dollar loan during any future emergency. Banks also mentioned the role that the product can play in boosting retention of customers, especially those attracted to fintech products and other niche products in the market, as well as for the purposes of cross-selling. Technology upgrades and legacy systems did crop up as another challenge that most banks face, especially when it comes to designing a small dollar loan, which is a particularly consumer-friendly product. But for many of the banks we spoke to, this challenge was largely surmountable given sufficient will within the bank. So this slide wraps up our presentation on Ideas 42's research. And before I turn over the webinar to Lois and the panelists, I did want to mention our memo that will cover this research in a lot more detail than I could do justice to today. And we'll share that memo with attendees a few weeks after the call. This presentation, as I said, captures only a portion of that work. So please do dig into the memo or reach out to us to learn more. All right, Lois, over to you.
Thank you so much, Tahan. I'll start with a quick introduction. I'm a principal behavioral designer at Ideas 42. My work here focuses on using insights and tools from behavioral science to improve the financial health outcomes of people living with low and moderate incomes across the world. I'm extremely excited to be joined by this great panel today, who will share their experiences in the small dollar lending space. Before we get into some questions, I'll give each panelist a couple of minutes to introduce themselves, as well as a very brief overview of their institution's work in the small dollar loan ecosystem. We'll also have some time at the end of the panel discussion to take questions from the audience. So please drop any questions you have in the Q&A box on your screens. Let's start with introductions now. And we'll begin with Christopher from Velocity. Christopher, please go ahead.
Yeah, appreciate the opportunity to be here today. Thank you. Thank you for that. So just to tell you briefly a little bit about Velocity. So we're in the business of trying to help community and regional banks and credit unions with technology to do things like offering small dollar short-term loans. And so this is an area that we have been really focused on of trying to do that, recognizing that a community bank or credit union in most cases is not going to be able to pull this off without some help from a third party. And that needs to be a true end-to-end, fully automated solution. So what we're trying to do is make that as frictionless as possible, both for the borrower and for the financial institution. In addition to being able to make the technology work, what are the benefits on the backside? Well, and we'll talk about this a little bit more later, but we've clearly seen an interest from consumers to solve liquidity needs. And you've talked about that already, John, in a lot of ways around the options that are out there now. And so what if we could do that within the bank, not to be able to compete just with those outside lenders, but to be able to compete with Chime, compete with Varo, compete with those non-bank fintechs and online lenders who are leading with liquidity. So being able to do that in a way we can apply for a loan that might be bigger than what Chime or Varo would actually give you, doing it 24/7, using an alternative data score based on cash flow instead of FICO, so there's no credit score hit or hard pull to do that, being fully electronic, available in the palm of your hand, integration with existing bank and credit union cores, being able to do this in a way that's completely compliant, including the Military Lending Act, without having to hire additional people to do it. So that's what we're all about at Velocity. Quick background on me: I was the lawyer in private practice for a lot of years before I came to Velocity. I've been in the consumer financial regulatory space for a long time, and am very interested in ensuring that what we're doing in this space is on the cutting edge of what consumers need, as well as continuing to be fully compliant. So thanks for your time today, everyone.
Thanks so much, Chris. It's great to have you here. Jaime, you can go next.
Hi, and thank you very much for the opportunity to be here. Jaime Jerusalmi, I am responsible for product for Wells Fargo personal lending that covers both installment loan products and also our private label cards. As part of my role, we developed and launched a Flex Loan, which is our small dollar loan in 2022. It has over a year of life since we launched it, and it's been a big initiative for us with a lot of good kind of things to say about it, and initial results we're very happy with the product.
That's wonderful to hear. Thanks, Jaime. Mike, can you please go?
Yeah, good morning and good afternoon, everybody. Thanks for the invitation from the Ideas 42 team to spend some time today. And also thank you for doing the research. What you shared with us is very interesting and I think great insights to what's happening within this space. So I'm with US Bank, and I was on the forefront and led the building of our US Bank Simple Loan product that was introduced in September of 2018. And we'll give a little bit more history and background about that and some of the learnings that we've had as we've experienced. But again, thanks for the opportunity to join everybody today.
Thanks so much, Mike. And last but not the least, BJ.
Hey, good afternoon or good morning to everyone, depending on where you are. Thanks for having me here today. BJ Gessler with Huntington Bank, run the consumer deposit products team, which includes management of our small dollar lending standby cash product. We launched it in 2021. Just a quick rundown of the construct of the product if you're not familiar. It's a digital only line of credit. We underwrite it based on checking account activity. We don't pull a bureau report for underwriting, although we do report out activity to the bureau. Some of the unique features of the product: no interest if it's on set up for auto pay. And we did just have a pretty significant change in the product. We added a 5% cash advance fee just this past weekend. But I would say, over 2 years in market with standby cash, it's been a really successful product both for Huntington and for our customer base, and I'm happy to be here to talk more about it.
Great. Thank you, BJ. Let's jump into the more exciting part of the discussion and ask the panelists some questions. I'll start with you, Mike. US Bank, like you mentioned, is the earliest bank of its skill to offer this product all the way back in 2018. Can you share with us what led you to do so at a time where very few major banks had entered the market?
Yeah, for sure. So 2018 seems like an eternity ago, as we all know, and actually would even go back beyond that. We had been active in the deposit advance solution space by providing a solution to our deposit customers. And in the 2013, 2014, that product ultimately ended up sunsetting. But the point of it was, this is an area that US Bank has been focused on in trying to serve our existing customers when they have those unexpected expenses or those disruptions in their income. So this isn't as if we just woke up one day and said we wanted to be able to offer a small dollar loan. This was an area that we had been really focused on. And then ultimately coming out of that 2014 window, we then started to then say, well, what are the ways in which we can still fill that gap? Because the need wasn't going away. What you had shared before around the Federal Reserve study about, consumers that can't get access to $400 back in 2017-18, I think that number was as high as almost 50%. So the need was there. It was very clear that the need was there. And ultimately, we wanted to find a way to be able to continue to serve our existing customers at that time when they needed a solution at that most vulnerable point. And so ultimately, then we decided we wanted to then think about a way to create a solution that aligned with all of the appropriate regulatory environments and really was a loan. And that was a key part of how we built this. And so that was the major driver about why we wanted to introduce a solution for our customers, and then got into market in September of 2018.
Thanks. That's really helpful context about the evolution of your journey to launching the product. I'll pivot a little bit in my next question to BJ. Our research points to the fact that small dollar loans have the potential to be a win-win for both banks and customers. And yet there are a lot of providers that are still weighing up whether or not to offer this product. What have been some of the major benefits that Huntington has experienced from offering small dollar loans?
Yeah, I would say, so Huntington in particular has a long brand history and record of promoting a concept we call fair play banking, where we try to give all of our customers an opportunity to have access to liquidity at a reasonable cost. So going back all the way to 24-hour grace, which launched unbelievably more than 10 years ago, up through the launch of standby cash, really building these types of products for our customers to give low cost access to liquidity is just sort of in the DNA of the organization. I will say, I think the launch of standby cash was probably even more successful than we had expected. So not only did it reinforce our brand position, but it proved to be an extremely marketable feature, and material impacts on incremental acquisition. And we continue to still see, over 2 years after putting it in market, really strong adoption from new to bank households. And then I guess I'd say, aside from, providing a really valuable marketing piece, aligning with our brand, it also, the way we built it, being a digital first product, and just, it's kind of a slick experience, the way you can get the money accessed instantly, really good user experience, really good enrollment process. It's kind of given us an option to show off our capabilities around digital innovation. So a lot of points that really have been a win for Huntington and our customers.
That really aligns with what we've heard from other providers as well, especially when you talked about the motivation to serve your clients genuinely and to provide a solution to liquidity constraints. To build on what you just talked about, one burning question in the space centers around the business case and sustainability of small dollar loans. Jaime, can you share a little bit more about how you think about the business case for your Flex Loan products? What have you learned along the way?
Yeah, that's a great question. I do believe that it is feasible to have a economically sustainable small dollar loan product with a reasonable APR, call it under 30%, but it is key to build it and manage it the right way. So one of the things we took extra care when developing the product is that we developed a digital-only, fully automated product that was going to be low cost. We knew that was key, and to be able to serve our customers in a way that was sustainable. And of course, we built a product that provided customers what they need, because some people think of, okay, let's do it self-service, but we build what we build and then it works or not. We took pains at building a product that has no application, it's fully self-service. So that was a key component of making it sustainable. I do think it's a journey. I don't think that small dollar loans are going to be a large profit pool. It's always more of a relationship play, but you can make it economically profitable at very reasonable APRs. And we are exploring as we test and learn. It's been a year. We have originated 500,000 loans in a year. And as we look forward, we're thinking about how we expand the use cases to keep growing the product and making it more profitable. But definitely it is possible. It's just that you need to build it the right way.
Great. Maybe we can stay on the topic of business case and sustainability a bit more and go a bit deeper. A related concern that we've heard, especially among the banks that do not offer small dollar loan products, is the difficulty involved in managing the technology development and the cost associated with the product launch. Christopher, you bring a unique perspective to this as a tech player in the space. Can you share a bit about the role that companies like yours play in helping make this process easier and more affordable?
Absolutely, and it's been touched on a few times with what others have said. Is it has to be fully automated. It has to be automated end to end completely. If you're concerned about the economics of this at all, you just can't afford to have any manual step in the process. And frankly, that's what consumers expect. Is they want everything to be instant. This needs to work instantly, and you've got to eliminate those barriers. And so, for larger banks like Huntington, which we're proud to partner with Huntington to help provide part of the technology behind what they do with standby cash. They have a lot of, and the other banks on this call got a lot of resources available to them. But we're not just dealing with those banks. We want this product to be more broadly adopted in communities that might not be served by a Wells Fargo, by a Huntington, by a U.S. Bank. So to do that, we've got to be really able to offer integration with core. We've got to be able to automatically fund loans. We've got to make all that stuff happen in a variety. Of course, there are tons of different core implementations, and so it's tricky to do that, but we've proven that we're able to do that. So you really need that third party to be able to give you the capability to be fully automated. The other thing is being able to have a score that's defensible in terms of how you underwrite this. If your goal is, as it is for us, to not have a FICO score, to not have a hard pull on a credit score that might cause additional jeopardy to someone who is already has a low score. And then the reality being that now potentially as many as 2 out of every 5 consumers are either credit invisible or credit unscorable. So you've got to be able to do that. So we've built a score that we've found has a very high correlation with ability to repay. It doesn't rely on a FICO score. It doesn't hurt a credit. And so the technology does everything from underwriting and offering that maximum loan amount digitally, letting you pick what amount you want to have, electronically sign the loan documents, process the loan, fund the loan, schedule repayment. All of that needs to happen seamlessly. And so that's what we're all about. The other thing I think I would point out is, the banks in this call, again, very large banks have a lot of resources, have a lot of ability to do research. If you're a community bank, say a $500 million, $1 or $2 billion community bank or credit union, you're going to be scared to wade into this space because you don't actually know what your charge-offs are going to be. That's one of the biggest concerns. And so being able to have a partner that can help you set the parameters around what you're going to offer is really valuable to those banks and credit unions to know we're going into this. Here's the expected losses that we're going to have, and that we can configure that. If we want to be more conservative, we can do that. If we want to be more aggressive, we can do that, which is, of course, how you translate the score to a dollar amount, helps you do that. But being able to meet those expectations, being able to not be scared to get into this, and we can talk later about why you want to do this in this competitive landscape with the large banks you got on the call here. That's reason enough that as a community bank, you need to be thinking about how to compete, but do that in an efficient way that benefits everyone.
Thanks, Christopher. I think the automation bits really addresses a lot of the concerns around business case, and I think has the potential to change the math really for getting this product to more people. So thanks for highlighting that. So I'm going to circle back to Mike. The journey to this point must not have been easy. It's been over 5 years since you launched your Simple Loan product. What have been some of the challenges that you faced in this journey, and what can banks looking to enter the space learn from your experience?
Yeah, I think there's a couple of things, and I'm going to build off of Christopher's point a little bit here. I mean, if you think back to, again, 2017-18, this idea of a small dollar short-term loan was really a pretty foreign concept. And I think that was one of the things that we learned very early on is, the consumer that needed access to a product like this was used to a particular product structure. And what we built was the complete opposite in so many ways. And so ultimately, right, we had to then how to educate the consumer, in particular, things like repayment and why auto pay makes sense versus a manual pay solution and the benefits associated with that. And so we had to spend a lot of time just how to create that visibility and awareness and that education, because again, the consumer was used to, if I need access to money through a payday loan provider or other alternatives, how the structure of that worked and how this was different. I think the other part then was coming out of the, as we were beginning to put together the justification, and this is, kind of building off of Christopher's point is, we wanted to get real data with real customers with real loans to get performance, because there was a lot of speculation in the industry. What would the charge-offs be? What would the performance be? How would this be profitable or not? And this was a little bit of why we ultimately did what we did in our journey. Is we had a very non-automated, very, very manual intensive process to book a loan, but the goal around that was to get data and insights versus starting with a starting point of I want to have the slickest, most customer-friendly experience. And so anybody that's thinking about this, right, one of the things that I would encourage you is how can you, even if it's not fully automated, even if it's not exactly what your end user experience would be, is go from hypothetical to real and book loans. And then not only book loans and see the performance, and the beauty of it is it's a 90-day loan, you're going to know within probably the first 30 days, 45 days, what's going. So you'll get real data. The other part was then actually talk to the consumers and learn from them, because then the consumer plus then the performance, the financial performance, the charge-off information help shape ultimately then what does your experience need to be? What did people like? What did they not like? And then how can you then figure out a way to be able to leverage either your own internal technology platforms or partners with Christopher to be able to bring it to market. But ultimately, right, you have to go away from hypothetical to real. And you can do it in a very controlled way I think the number was like 2,105. We booked 2,100 loans, and the insights that we learned from those 2,100 loans early on was so valuable for us, for our collective team, and other stakeholders.
Thanks a lot, Mike. I really like the statements, real data with real customers with real loans. And that segues pretty well into the next question I had, which is around the types of customers that are taking out these loans. A lot of the stakeholders we've spoken to had a lot of questions around the profiles of small dollar loan borrowers. My question will be directed to BJ. Can you share a bit more about the types of clients you're serving with standby cash and why they take out these loans?
Yeah, I think it's a more diverse population. I think than most folks would assume, and probably more diverse than we would have assumed before we launched the product. Certainly the product serves folks that have a challenged credit history. That's one component of our customer base. But I'd say, the flip side of that, and I think it has to do with how convenient it is to access the product and use it. I'd say about a third of our users have, very strong credit, either a prime or super prime. And then, similarly, the core of our users are a mass market audience, but again, about a third of our users also fall in the mass affluent and wealth. So it fills a diverse set of needs across a really broad customer base. In terms of reasons for using the product, I think that the research that was showed earlier pretty much is very consistent with our findings. About half of the usage was to avoid an unexpected expense of some sort. The other half of the usage, fall into a general category, was to prevent overdraft. So could have been from any of the drivers that were referenced around, sudden loss of income or change in income pattern, but in general, specifically to prevent that overdraft usage or incurrence of an overdraft. Those are really the two main reasons that we see. But yeah, it's an interesting customer profile. It's giving a lot for us to think about in terms of our strategy and how do we potentially expand the use cases beyond what you would think of as a traditional small dollar lending product user, because we do see that there's demand kind of across the spectrum of our client base.
Thanks, BJ. I'd like to remind the audience that feel free to drop questions into the Q&A box. We will have a Q&A session after the panel discussion or at the end of the panel discussion. I'm going to ask us to now look forward and reflect on ways to improve the impact of these products as more banks look to enter the market. So first, from the customer perspective, I'm going to direct my question to Jaime. We know that some of the borrowers we've spoken to have expressed a desire for a relationship between their small dollar loans and building credits. In part, this is because some of them want to graduate towards other credit products. What role do you see for small dollar in this regard? And have you seen any evidence of this over your product history so far? Jaime, I think you're muted. Yeah.
Yes, sorry, great question. So we don't use credit bureau for loan origination, but we do report loans to the bureau once boarded. So that gives a path to customers for building history. It's too early to say, but definitely smaller loans should be a product that help, especially the thin file customers or the new to credit to build great history. I do think that there's some things with the reporting of loans to the bureaus that need to be fixed to help in this process because today small dollar loans are reported like any other loan. So if you take too many loans, which you typically wouldn't do for the larger loans, it might actually be negative. So some history is good, too much history is bad, but I think it should be a good tool to build credit. Ideally, we would have small dollar loans reported differently so that it is understand that you might take more of those. That doesn't necessarily mean it's a bad thing.
That's a really good point. I think it's something to think about. Thank you.
And we have limited the number a customer can take, partly because of responsible lending, partly because of this. Our customers can take more than 3 loans over a 12-month period, and which constraints, but also we are learning, we're testing and learning.
Great, which makes sense. Learn as you go. So, thank you so much. So I'm going to ask my last question of this session to Christopher, and this is about the regulatory landscape. The 2020 joint guidance provided important regulatory clarity for banks looking to serve their customers with small dollar loan products. Do you see an additional role or actions that regulators can take to encourage more banks to take up these products, or for the banks that already do to widen the availability within their banks?
Yeah, just a couple of things on that one. I do think it was helpful to have that guidance, and we were very happy to help participate in that effort of speaking to those regulators alongside Few Charitable Trust, which I need to give a shout out to, has been a tremendously positive force in this movement of trying to make good things happen in this space. So I think that ended up about where all of us probably hoped that it would. The only sort of subsequent to that thing that I would say that I don't think has been helpful is the CFPB withdrawing the no action letter process, which meant that small dollar credit no action letter template that the Bank Policy Institute formulated is no longer out there and available. And of course, Bank of America got a no action letter for that product. I think that was helpful, and it wasn't just for the banks over 10 billion, but those under 10 billion as well that could look to a set of basically a safe harbor sort of guardrails, which created, from our view, sort of like a safe harbor of what you should be doing, which we were already completely compliant with, but also helped us assuage some fears among bankers about what regulators were going to think. And so frankly, it's been the bigger challenge for our clients at this point has been more about the examiners in the field than it has been the policymakers in DC saying that these products are something we don't really understand. We want more information. We're concerned about. And back to Pew for a moment, their position is that, triple digit APRs are something we want to stay away from, but double digit APRs are okay. And I know my US Bank's product is not the way anymore, but you all were offering, I think at one point it was in the sort of low 80s, I think is what the APR worked out to with the loans that you were doing. So I'm assuming you faced some of this pushback as well. But for our smaller banks that don't have the kind of efficiencies that a lot of the bigger ones do, they might be charging sort of in that 50-something percent APR, 60-something percent APR, and they get examiners saying it shouldn't be any more than 36. Of course, we have the ability to reconfigure the loans automatically for MLA qualified borrowers to get them under that 36% military APR cap. But even when the FDIC tried this pilot program years ago with a 36% APR, they had very few takers. And when Sheila Bair left, after she left the FDIC, she actually sent them a letter back and said, you shouldn't be capping these at 36% APR if it means that banks are not going to do the programs, not going to do programs like this, because the alternatives are so much more problematic for borrowers. We would much rather have consumers borrowing from their bank or credit union at a 54% APR than we would have them go to a payday lender, go to a pawn shop. These are not good options for them. And the other thing that I've learned over the years and really resonates, I think, when you start to really put yourself in the consumer's perspective, is the harmful things about those alternatives that this hasn't been touched on so far, and I just think is so important, is the repayment terms are not just about how much you pay, but not being able to stretch this out over some period of time. And the payday loan of getting drawn out at your next payday, or generally no more than 2 weeks in one lump sum, is incredibly harmful to consumers. And so the option of spreading this out over a 3-month period, fully amortizing, being able to get caught up in your financial life, is a huge asset to a consumer. And so if I'm going to pay an APR that could be 50 something, 60 something percent for that ability, it's far better than something that we're trying to squeeze into a box to reduce our risk, because as we all know, the further you stretch out the loan repayment time, the riskier it becomes to the lender. And so you need to be compensated for that. And I think that's where ultimately these products are going to go. I know that we can get losses down to where they're manageable, but banks at some point need to have some margin, of margin for error, or room for charge off to be a bit higher in a potentially recessionary environment. So they need to be able to be compensated for that. And the smaller banks need to be able to pay third-party service providers to help them offer this, or they're not going to do it at all. And so I think I think some sort of recognition by examiners in the field that if what a bank is doing or a credit union is doing is designed to help consumers, and do that in a way that's fair and provides payment terms to them that are ultimately in their best interest, the headline APR is not the number one thing to be concerned about.
Thank you so much, Chris. I think that gives all of us a lot to chew on, and it's a call to action for everyone here. I appreciate your thoughts. So I'm going to be switching gears a bit and moving us into what we're describing as the rapid fire session of this discussion. And the instructions are basically that I'm going to read a statement to each of you, and I'd like you to first state whether you agree or disagree. Once you state your opinion, you can explain your response in just one sentence, and try to stick to one sentence if you can. So I'll start with Jaime. Here's your statement. As more and more banks. Sorry, I think you have to mute. Yeah, thank you. As more and more banks offer small dollar loans, fewer people living with low and moderate incomes will use predatory loan or predatory lending services. Do you agree or disagree?
I agree, less customers will use predatory services, yes.
And your explanation for your position?
The explanation is, if we can build better products that are more affordable than what predatory lenders are offering, it's going to be a natural switch. We are seeing it.
Thanks, Jaime. I'll move on to BJ. Do you agree or disagree? Banks have largely worked out the business case for small dollar loans.
Yeah, I disagree. I think banks struggle to figure out where small dollar loans fit into their overall product strategy and what they're trying to accomplish with small dollar loans. That, coupled with uncertainty around the financial assumptions for losses, makes it really challenging to make a compelling business case within most, really most any bank.
Thanks, BJ. I'll move on to Mike. If banks were given CRA credit for offering small dollar loans, more banks will do so.
I will say agree, but it doesn't. That is not a primary driver or reason why somebody would choose to offer a product like this.
Okay. Thank you. Anything else to add in one sentence?
Oh, I thought that was my one sentence. I mean, the primary reason why somebody is going to take out or why a bank is going to offer the product isn't being driven off of offering CRA. It's everything else that all of us have talked about for the last 45 minutes of the needs that you're meeting, serving your clients, having more responsible solutions. So that's ultimately the core reason why I think institutions will offer it.
Thank you. I think I made you break my own rules, but thanks for playing along. And then finally, Christopher, here's your statement. By 2025, all large banks will offer small dollar loans to their clients.
I'm gonna hedge. I'm gonna say that all large banks by maybe 2030 will offer these because of the competitive environment with 6 out of 8 of the largest banks already doing it, and the fact that it's the right thing to do for consumers. Plus the fact that you have when you really look at the data, these are not just all ultra poor people that you're lending to. You're lending to people who, in many cases, have 6-figure incomes, have timing issues. These are great potential customers. This is going to become an account acquisition tool, because Chime and Varo and others are leading with this. Those large banks are going to realize they need to be able to lead with liquidity to acquire accounts and make those accounts more of what they want in an account with their bank.
Thank you so much for humoring me and playing this game about a very serious subject in meeting short-term liquidity needs of millions of people across the US. It's been really insightful, and I appreciate your contributions. I'm gonna switch over to the Q&A and open to the floor for questions from the audience. Tahan has been collating the questions, so I'm gonna invite Tahan to kind of help moderate this session.
Yeah, absolutely. Apologies in advance if we don't get to all of your questions. We just have more questions than we have time to answer. I'm going to try and combine as many of these that are around similar topics into sort of a single reformulated question. And this first one is around sort of the scale and reach of small dollar products. And so this is for any of the banking panelists, but I'll pick on you first, BJ. How has your bank thought about how to scale these products and reach consumers who would benefit most? And then sort of add-on question, what prospects for growth do you see for small dollar loans, both in terms of the number of institutions offering these loans and then the scale of product at existing institutions?
Yeah, in terms of scaling it out to our particular customer base, like how could we get it out to more users and find more use cases? I would say one thing that Huntington has learned is to sort of step slowly and learn fast as you roll the product out to understand your underwriting standards and how you set limits and what your true loss rates are going to be to make sure you're running sustainable products from a P&L point of view. We have headed down a path where we were fairly open with our underwriting standards when the product launched. We've had to scale back on that quite a bit, which has limited the amount of access that we could provide to it. So our focus now is, how do we start turning that dial back in a different direction, find some of those users that Chris referenced that, they aren't just, liquidity starved. Sometimes folks just need quick access to cash no matter where you're at on the income spectrum. How do we refine our underwriting and our limit setting processes to get there? And so you have to be willing to invest in the product to answer those questions. And you also have to have a sustainable economic model, which is one of really the key reason we implemented the 5% fee for standby cash. In terms of expanding in the industry, I think, again, getting back to my comment earlier, banks need to understand where the product fits into their strategy. Is it a CRA play? Is it truly to offer liquidity? Is there a real economic opportunity there? Banks have to figure that piece out. And I guess one other sort of tactical barrier I think I would put out there is it's sort of a unique product. If it's underwritten on deposit product flows, yet it's a credit product, that's a weird fit in a lot of organizations. And I think that's part of the challenge that it has in getting traction, particularly in large banks, because lending and deposit teams tend to, not have a lot of daily cross interaction and innovation and product development. So it sounds small, but in practical reality, it's actually a pretty big deal.
Awesome. I think another question that we have that we sort of alluded to in various parts of this conversation, and I'll address this to you, Chris, but again, feel free, other panelists on the call to chip in after Christopher answers. We have some questions essentially around if clients are, or if there's evidence of clients using payday loans or other high cost products less after taking out small dollar loans, or another way an attendee phrased this question was, are clients using these products as substitutes for some of the other high cost products? And what evidence of that are we seeing?
Yeah, it's a great question. And that's where we would all obviously like to end up. Our data shows that about 15% of consumers at a typical bank are using some sort of external liquidity solution, whether that's a payday loan, could also be buy now, pay later, could be an installment loan, cash advances, those sort of things. I think the goal is to bring down the overall cost of what consumers are paying, essentially per on a time-adjusted basis per dollar of liquidity, what are you paying? And I think that's all of our goal. And so moving away from the more harmful, high-priced alternatives is where we want it to be. But I think when there's a need for a consumer and a business is willing to serve that need, consumers are still going to that business. So the answer from our data is we do see consumers trying to take advantage of whatever liquidity is available to them. But the proof of whether they can afford that is in the charge-off rates. And so we know that even if they might already still be borrowing from a buy now, pay later lender, for example, and also taking a cash please loan, we know that our underwriting is still appropriate when we see those charge-off rates being very manageable, low single-digit kind of charge-off rates. The goal, obviously, like I said, move away from that. The reality is consumers are, I think, in many cases trying to get caught up. And if someone offers them an option, they're going to take whatever options are out there available to them.
Thanks, Chris. Does anyone want to add to what Chris said?
This is Mike. I'll just chime in with one thing. I think sorry, Jaime, I think you need to mute Jaime. There you go. I think one of the things is obviously your product structure, and Jaime actually alluded to this, right? If you have limitations on how many times they can be used, if the consumer still has a need, then they'll be forced to potentially go find other options, other solutions. And I do think then part of this is also doing some really interesting testing and learning of, do you allow a consumer to have more than one loan outstanding at a time? Do you allow them to, what is your cooling off period to then be able to get those learnings? And then do you see ultimately any changes in usage of other solutions to potentially fill gaps? Because if there's a need, the consumers and the bank isn't able to fill that need because of product structure limitations, the consumer's still going to be forced to have to go find other alternatives.
Yeah, I just want to add real quickly because, and I know, Alex and Nick from Pew are participating but not on. But one of the things I'll tell you that Pew told me, which really hit home, is, when you're thinking about having a cooling off period, even if that's as little as 1 day, when you do that, you're essentially forcing those consumers to go somewhere else in some cases and take a more harmful product. And so I think, I'm not speaking for Pew, but I think the view has been moderated some that a cooling off period is not as important as it used to be when you consider that when it is a low cost or lower cost product, it's better to roll that over than it is to go to a higher cost product to pay off a lower cost product.
Yeah, maybe to add to that, I think we've heard and seen banks experimenting and evolving around how to manage cooling off periods. And at an FDIC panel last year, Bank of America mentioned moving away from a 30-day cool-off period to now having a cap on the number of loans clients can have within a 12-month period. So I think clients will take loans within 12 months, which is an interesting evolution in the space.
And we don't have a cool-off period. We just have a limit for how many loans in a given time period. But our numbers show that on average, a customer takes roughly 35 to 40 days between paying off the first loan and taking a second one, which makes me think that a lot of these customers are really thoughtful about how they use these loans. And so, yeah, I thought it was interesting to throw that.
No, absolutely. I have another question that I know we're rapidly running out of time, but I do want to ask because we're really fortunate to have, I think, a lot of the individuals at the banks who've sort of driven the launch of these products and seen it through. So we do have a few questions, I think, from some of the banking professionals on the call around some of those internal conversations that are happening in your banks around launching these products. So one question for all of the bankers on the call: how important was the engagement of executive leadership to offer these types of small dollar loans? And then relatedly, what sort of pushback do you receive internally when launching these products? And then how did you go about addressing that? And this is to any of the—
I can take a start. Who wants to start?
I would say for Wells Fargo, having executive sponsorship from the CEO level down was incredibly important, not only for the decision as a strategic decision and commitment to launch the product, but even in building the product, having that sponsorship made a huge difference. It has to come from the top of the house.
The thing I would add is it starts with alignment to strategy. And I think BJ had mentioned this. It starts with alignment to strategy. And then if you have alignment to your strategy, then by default, your executives should be aligned and be endorsing. So I don't think it starts with executives. I think it starts with your strategy, and then ultimately you have that connection and your alignment. In terms of the challenges, not to sugarcoat it, it's never ending, right? And I think it's a little bit different today than maybe it was again several years ago. But you'll run into challenges because it is new, it is different, and it is something that you don't have. Maybe people in your organization, in whatever support function, don't have experience and understanding around this. And so, being an advocate and champion for the consumer in who's ever building it is critical for success as well.
Yeah, and I think I would just add, it's not a small investment, right? And there's no shortage of investment opportunities for banks and where they want to put their people and where they want to put their technology dollars. So if you don't have full executive support, it's easy to find yourself in a position where you get halfway down the path and priorities change, and you never get the product to life. So my experience, you have to have the executive support. I would agree all the way up to the top.
Thank you so much. Unfortunately, we are at time all too soon. We have to bring this conversation to a close. I genuinely think we could stay here all day. There's been so many interesting questions that have come up, but hopefully we can keep this conversation going, and we will be sharing our memo with you as well with some of the insights that we've heard from providers. So please look out for that. I want to say a big thank you to the panelists for joining us. Thanks so much for sharing your expertise, for your time and your insights. It's been really, really helpful and educational. I just want to thank our audience and all the participants for being here and for your engagement and your questions that really have given us a lot to think about. Thank you also to Pew for funding this work, and to our team for all the work put into this. Have a good day, everyone.
Thanks.